Hi, I'm James. Welcome to Sketching Finance, where we simplify finance through visual storytelling.
Welcome to Day 8 of your financial transformation.
Many people think that keeping money in savings accounts or buying gold is boring, or just for those who are afraid of the market. They see it as a static pile of cash that sits idle. But as a wealth builder, you must change your perspective entirely. The difference between an ordinary saver and a professional investor lies in strategy. Today, I will show you how to turn these seemingly dull channels into a high-performance launchpad for your wealth. We are not just saving money. We are managing what professionals call dry powder. This is the fuel that will allow you to capture life-changing opportunities when the rest of the world is panicking. In the world of finance, your defensive line is not just about protection. It is the foundation for your most aggressive offense. By the end of this session, you will know how to build a fortress that is not only bulletproof, but also ready to strike when the time is right. Let's start with the most common defensive asset, savings. Most people fall into a classic liquidity trap without even realizing it. Imagine you have $10,000 in your emergency fund. To get the highest advertised interest rate, you lock the entire amount into a 12-month certificate of deposit, or CD, at 5%. On paper, it looks like a win. You think you've secured a good return, but you've actually traded away your most valuable asset in a crisis, your flexibility. Suddenly, in the third month, life happens. Your car breaks down, or you face an unexpected medical bill. You need $2,000 immediately. Because your money is locked in that 12-month CD, you are forced to break the entire contract. The bank penalizes you by dropping your interest rate to a near zero, 0.1% for the entire duration. You lose all the earnings on your $10,000 just because you needed a small fraction of it. This is a massive failure in liquidity management. To solve this, we use the savings ladder strategy. Instead of one big $10,000 block, you divide your capital into 4 smaller rungs of $2,500 each. You place the first rung in a 1-month CD, the second in a 3-month, the third in a 6-month, and the last in a 12-month CD. This structure provides you with the high interest rates of long-term deposits while maintaining the constant availability of cash as each rung matures. If you need cash, you only liquidate the rung that is currently maturing, keeping the high interest on your other 3 rungs completely intact. If you don't need the money, you simply roll over the maturing rung into a new 12-month term. After 1 year of this cycle, you will have a perfect ladder where a high-interest 12-month CD matures every 3 months. You have mastered the art of being both liquid and profitable at the same time. In the modern digital age, the manual ladder is being replaced by Savings 4.0. In the US and Europe, Fintech platforms like Wealthfront, Marcus by Goldman Sachs, or Ally are killing the traditional CD model. These platforms offer high-yield cash accounts, or HYSA, with rates that often match or beat 12-month CDs, but without any lock-in periods. Your money stays fully liquid, meaning you can withdraw it tomorrow without losing a single cent of interest. These digital accounts use daily compounding. If you deposit money on the 1st and withdraw it on the 15th, you still receive the full interest for those 15 days. Additionally, features like buckets allow you to mentally separate your emergency fund from your opportunity fund within the same account. However, as an investor, you must always look for the Member FDIC badge. This ensures your deposits are government insured up to $250,000, protecting you from a bank failure. Don't be fooled by the high numbers shown on your banking app. Professional investors always calculate the real interest rate. In the US and Europe, your interest earnings are treated as ordinary income, meaning the tax man takes his cut first. If you are in a 22% tax bracket and your bank pays you 5%, your after-tax return is actually only 3.9%. When you subtract a 3% inflation rate, your real wealth growth is a measly 0.9%. If inflation spikes to 4% or 5%, your real interest rate becomes zero or even negative. You are effectively losing purchasing power every day, even though the numbers in your bank account are increasing. This is the illusion of wealth. When the real interest rate drops below 0.5%, it is a red alert signal. This is your pivot point, indicating that it is time to move a portion of your idle cash into assets that actually protect against the erosion of money. If you're finding value in this video, please consider subscribing. It helps me create more content like this for you. For larger capital, you should look beyond the local bank. Treasury bills, or T-bills, are the gold standard of the defensive channel. They are backed by the full faith and credit of the U.S. government. One massive advantage for U.S. investors is that T-bills are exempt from state and local income taxes. If you live in a high-tax state like California or New York, T-bills can provide a significantly higher after-tax yield than a regular savings account. You can build a T-bill ladder by purchasing 4-week bills every week. This ensures that every Thursday, a portion of your capital matures and hits your account as cash. If you don't need it, the system can automatically roll it over into a new bill. For those who fear long-term inflation, the U.S. also offers I-bonds, which automatically adjust their interest rates to match the consumer price index. These are the hidden weapons of the defensive channel that retail savers often ignore. Now, let's talk about the most misunderstood defensive asset, gold. Many people buy gold because they see the price hitting new highs on the news, but that is the mindset of a speculator, not an investor. In a professional wealth architecture, gold is not for making money. It is for protecting value. We view gold as a form of global asset insurance. It is the only currency that has survived for 5,000 years without being tied to a government. You should buy gold and secretly hope that its price never goes up. Why? Because gold usually only spikes when the world is in chaos, when inflation is out of control, or when trust in the dollar is collapsing. It's like buying fire insurance for your home. You pay the premium, but you pray your house never burns down. We recommend keeping 5% to 10% of your total portfolio in gold to act as a stabilizer during extreme market volatility. When buying physical gold, you must be aware of the spread, the gap between the price at which you buy and the price at which the shop buys it back. If there is a 3% or 5% difference, you are instantly at a loss the moment you leave the store. Gold must rise by that same percentage just for you to break even. This is why physical gold is a long-term play of at least 3 to 5 years. Never attempt to day trade or flip physical gold for quick profits. For modern investors, gold ETFs like GLD or IAU are often more efficient. These funds track the global spot price of gold with 99.9% accuracy and can be sold with a single click. You avoid the high spreads of physical dealers and the costs of secure storage. However, remember the golden rule. Buy gold when no one is talking about it. When you see headlines of people lining up at gold shops, the price is already at its peak. Buy when the market is quiet. Even the biggest banks can face systemic risks. The 2023 collapse of Silicon Valley Bank was a stark reminder that no institution is 100% safe. In the U.S., the FDIC insures your money only up to $250,000 per person per bank. If you have more than that, don't just leave it in one place for convenience. You can use the joint account hack with a spouse to increase your protection to $500,000 at a single institution, doubling your safety net instantly. For those managing millions, professional brokers like Fidelity or Vanguard offer cash sweep programs. Their software automatically splits your large deposit into $250,000 chunks and spreads them across 10 or 20 different partner banks like HSBC or Citibank. You see one total balance on your app, but every dollar is fully government insured up to $2 million or even $5 million. This is how the wealthy build a fortress of cash that can survive any banking crisis. Finally, the most exciting role of your defensive channel is the counterattack. We don't hold cash just to feel safe. We hold it as dry powder to strike when the market crashes. You must set your trigger points now while you are calm and rational. If the S&P 500 drops 10% from its peak, you withdraw 10% of your idle cash to buy the dip. If it falls 20% into a bear market, you withdraw another 30% to buy high-quality assets at a discount. When a 30% crash occurs, a once-in-a-decade event, you should be aggressive. This is the moment to sell your gold, which is usually at its highest price during a panic, and use that capital to buy stocks at their lowest. This is called rebalancing, and it is the smartest way to manufacture wealth. You are no longer a passive saver. You are a hunter waiting for the perfect shot. Subscribe to Finance Today, and I'll see you in Day 9 as we move into the Attack channel.